In the last video, we talked about the average performance of different categories of investments. And we learned that an investor that picks stocks at random could expect average gains of about 12% per year, which must mean that if we're selective in what stocks we purchase, we could expect greater than 12% returns. Hi, Matt Bernstein here from Low Cost Hustle, and this video will give you an idea of how well professional money managers do. Let's begin by looking at performances of mutual funds. For those of you unfamiliar with the term, mutual funds allow a large group of investors to pool their money together to buy any number of stocks. Run by one or more money managers, mutual funds provide investors with access to professionally managed portfolios of stocks. They aren't free, and some of them have very high expenses and fees. Investors invest in mutual funds with the belief that the money manager knows how to generate high returns. It is their job after all. Surprisingly, studies show that more often than not, mutual funds fail to beat the performance of the broader market. Although professional money managers often have advanced degrees in economics and finance from some of the best business schools, studies consistently show that only 1 in 4 mutual funds outperform the market. This is a shocking result that shows 3/4 of funds performing worse than an individual picking stocks at random. Just like you and me, professional money managers want to make as much money as possible, and often that comes as an expense, literally, of their investors. It turns out that high fees and expenses are one of the main reasons for this trend of underperformance. Although many of these fund managers are quite good at picking stocks, the fees and expenses they charge can end up eating a large chunk of gains passed on to the investor. And so a fund that earns 14% return on its investment but charges 3% in expenses actually ends up underperforming the market average of 12%. Does this mean we should avoid mutual funds? Well, that depends on a number of factors, including, and not limited to, how old you are, how much money you have to invest, do you have enough time to do your own research? I would argue that if you aren't elderly or already retired, if you don't have more than $10 million, or you aren't too busy during the day to research stocks on your own, then I would avoid investing in mutual funds because the benefits of investing on your own versus in mutual funds outweigh the negatives. Before we go further, I'd like to explain 2 terms that you should be familiar with, and those are sectors and indices. When we talk about indices, the Dow Jones, NASDAQ, and S&P 500 are the most frequently mentioned. And the purpose of these indices is to track the performance of a group of stocks. So for instance, the S&P 500 tracks the performance of the 500 largest companies in the United States. When we say that the S&P 500 is up by 10 points today, we mean that the average increase in stock price of all the S&P 500 stocks was up $10 for the day. Some of those stocks have risen higher, some lower, and some will have even lost value. But on the average, the index was up 10 points. The Dow Jones, also known as the Dow 30, the Dow Jones Industrial Average, or simply the Dow, is an index that tracks 30 very large companies in the United States. And the NASDAQ Composite is an index that tracks the performance of about 3,000 stocks, most of which are technology companies. There are many more indices, but those 3 are the most commonly mentioned. Sectors describe a particular subgroup of the economy. Technology, finance, energy, and utilities are examples of different sectors, and they will have very different behaviors due to the different markets they represent. It is common, for example, to use the NASDAQ Composite as a gauge for how well the technology sector is doing, and the Dow and S&P 500 are gauges for the overall economy. In recent years, exchange-traded funds, known simply as ETFs, have been gaining in popularity. ETFs are like mutual funds in that they hold any number of stocks. However, unlike mutual funds, a money manager does not choose the stocks an ETF holds. Rather, an ETF is typically used to mimic as closely as possible a particular index or sector. For example, if you wanted to match the performance of the S&P 500, then rather into buying all 500 stocks one by one on the S&P 500, you could buy an S&P 500 ETF, the most famous of which being the SPDR SPY. Whereas if you wanted to match the performance of the financial companies only, you might only invest in a financial ETF, the most popular being the SPDR XLF. The advantages of ETFs is that they allow investors to trade entire indices and sectors as if they were single stocks. ETFs do have fees and expenses, but they are usually lower than those of mutual funds. And it turns out, for the same reason as a mutual fund, the average ETF fails to beat the market because of said fees and expenses. Does this mean you should avoid ETFs? For the passive investor, without time to do research on his or her own, I would argue ETFs are a better option than mutual funds, due largely to the smaller fees and expenses. But for the active investor looking to beat the market, individual stock selection is the way to go. If someone else is doing the heavy lifting for you, then you can be sure that they're taking a cut for themselves. This video should have given you the idea of what the advantages of investing on your own versus entrusting your money to someone else. If you're willing to take some time to do your own research, then it is very possible to achieve a much higher return than what most money managers can offer you.